We want to thank you for joining us. This is MPRN. We're also simulcasting on our radio station, MPRN, which is found in our mobile app at bygodinspired.org, or you can search for it on Google Play or the App Store, search for MPRN, and you can hear us. But it's really good to have folks really wanting to learn more about the importance of investing. And I am, let me just preface this by saying that I am not an expert, as I've always said, but I believe that what God gives us, the information on how to move forward, it's His grace and mercy. And so what is freely given should also be freely given. With all of that being said, I want to thank Bobby Peters with LP&L Financial in Memphis, Tennessee, who is joining us on this 101 Investing for Beginners. I shortly will let you Bobby share with us a little bit about him, just so that people will know that I didn't get some person just off the street to help us understand what is going on. Bobby is a longtime friend of mine. He also manages a major portfolio with the organization that I work for. It's a 7-figure portfolio, and we've entrusted Bobby and LP&L with that. He also manages my personal itty-bitty portfolio. And so I have put my complete trust in his expertise. He's a man of God, because let me just share this with you, that this work that God has given me to do is really about helping people see money different and also beginning to invest. For a long time, our people particularly, we just tried to make it, and then from generation to generation, we've always had to play offense and defense at the same time, because we had systems of institutional racism and things of that nature that constantly tried to keep us from what God has for us. But I am here to tell you that what God has for us is for us. He wants us first to seek first the kingdom of heaven and His righteousness, and then things will be added on to us. So the old theology of get to the cross and stay there and just wait till you die to go to heaven to experience the abundance, that's not entirely true. John 10:10 tells us that the enemy is the one that comes to kill, steal, and destroy. What he wants to kill, steal, and destroy, he wants to kill your soul. He wants to rob you of your hope, and so that you won't move forward boldly in this earth, in the lifespan that you have to do some amazing things. But Jesus says in the other half of John 10:10, but I have come that you might have life and that you might have it more abundantly. So let me give you just some revelation on that. He wants you to have life right now. He wants you to have abundance right now, but you first have to see what He's already given you to appreciate what you're walking into. And that abundance will go into greater abundance. And abundance may not necessarily equate to dollars and cents. It may equate to the favor of God. It may equate to the wisdom of God around certain things that don't cost you money, but elevate you. So that's why we're here. Most importantly, I want us to seek first the kingdom, and then God will give us wisdom on how to move forward individually. We all are unique, and He has specific assignments for us. Those assignments will require some resources. So God wants you to be a cheerful giver so that He can bless you. And so this is what this is all about. So let's just begin with Robert Peters of LP&L Financial. And then so the agenda goes as follows. We're going to talk about some things, and then we're going to open it up for some of those who are on this Zoom. You ask some questions, and we ask those of you who are here, mute your phones. And those of you who are watching in the group, you can jump in if you want, or you can watch us from the group. I don't have any way at this moment of monitoring what you all are saying in the group, but I will go there at some point to look and see, and then ask Mr. Peters. So Mr. Peters, welcome. I see we don't have your picture. Love to see your video, but hey, that's absolutely okay. So tell us a little bit about yourself, and why should people trust your expertise?
Well, thank you, Vincent. Listen, I've been in this business for over 13 years. When it comes to the simplest form of investing, it started out with raising money for bonds. I used to be a municipal trader and underwriting associate for Morgan Keegan. And at that time, what we did was we raised money for like ML, GNW, sewer type projects. It may come up to like $200 million. We have investors that are willing to give their money in return for a coupon, interest rate over a certain period of time. From there, I've been with Morgan Stanley for 9 years up until 2017. And now I am with LPL Financial, which is the largest independently owned brokerage firm in the world. So trusting my expertise, we go from IPOs. If you're familiar with Facebook, I heard you mention that. Morgan Stanley was one of the underwriting firms to launch that stock. And so we had a lot of clients that were interested at the time. When it comes to the same situation with bonds, that's putting it first onto the market. So when it comes to just finding out how things are formed, the structure, the standardization that's across all the industries, I have detailed knowledge how things work and really what to look for to come across an investment that's specific for individuals. That's my background. Hopefully I'll be able to add value to the call today.
Awesome. Well, thank you so much for that. First and foremost, let's just get started. Investing is, it can be a challenge for a lot of people who've never actually been involved in this. And as a result, they're a little scared to be investing. And so I just want to start with the basics related to investing, like literally what is investing? What should we be doing? I could speak for a lot of folks who are watching this and who will watch it later on. I have some money, not a whole lot of money. I'm hearing about all of these apps, and I know you're not here to endorse anything, that we don't do that. We hear about Robinhood, we hear about Cash App, all of this stuff. Don't I need a broker or somebody to do this stuff? Because I don't know anything. So tell us about investing. What is it and why is it important?
Well, no, to answer your question, do you need a broker? You do not need a broker, but it doesn't mean that it's not wise to have one. I'm assuming that you're using the term broker synonymous with an advisor. And so when you go into the field of investing, there are some protections that are out there for you as a retail investor. Doesn't mean that you will not make mistakes when you invest. Some think that investing is guaranteed. And we do know that outside of a CD that's with a savings account or with the bank, it is not guaranteed in this market. So you are free to invest, to gain, and also to lose. So the simple form, the definition of investing is trading your assets for either ownership in a stock or lending it to someone that will pay you a dividend or interest on your amount that you put up. So you want to look at it in those two simple forms. Everything else they would try to, how can I say, reinvent themselves in those two forms. You're either lending or you're taking ownership in anticipation of receiving dividends or taking part in a growth of a company.
So as we look at companies, the biggest thing for us is the basic principles of investing is, we have to change people's minds around how they see their money. And I've talked to a lot of people who've inboxed me or have texted me if they have my personal number around this. And I always use the preface, hey man, I'm not an expert, but I will never take somebody somewhere I have not been. As it relates to being able to use limited resources that we have, what do you think we should be doing? Should we be spending our money to gratify ourselves? That would be called consumerism. Or should we be using some of our discretionary resources to build wealth and leave an inheritance? So Bobby, as an expert, we know that capitalism is driven by consumerism. So this society, this country, the world needs people to be consumers. So what's the difference between a liability and an asset? What are those things?
Okay, great. So without getting too technical, a liability is like a mortgage. It's like a car note, student loans, which is a big topic in today's news and media. So those are liabilities, things that you owe someone else. Assets are things that you possess. You can have a house, but you can have a house with a mortgage. That mortgage would be a liability. The asset, the structure, the improvement of land would be the house. So we look at assets minus liabilities, which give you your overall, what we call, net worth. So if you have a mortgage that's 100,000 on a house, and that house is worth 150,000, congratulations. You are $50,000 in net worth just by owning that asset and also leveraging it with a mortgage. So should we invest? Of course we should. That's the best way to outpace what we call inflation. And inflation is simply states that the price of eggs and milk in 1980 will cost more than the price of eggs and milk in 2021. You want to be able to keep up with that. So if that kind of answers your question there, hopefully it comes to some great wisdom and some understanding of why should we invest and the difference between an asset and a liability.
So let me break it down for some of you all. We've been taught to make ourselves feel good, go buy a bunch of stuff. The moment you go and buy stuff, whatever that is, a house is a good liability, as he says, because it's an investment. And as you build equity in the house, in other words, the amount that you owe is less than what the house is valued at, you're in a good position. That is an asset, net asset that you have. But most folks who didn't have a lot of resources to go and invest because of the trauma that's been inflicted on people over the course of many generations, when we make a little money, we often go and buy ourselves something nice, whatever that is, whether it's going out to eat, whether it's going buy new clothes, new purses, whatever that might be, shoes. And what we have to understand is, while that is absolutely okay, remember, the minute you take your money and you go out to dinner and you drop $50 to $75, depending on how many people are eating with you, you lose that cash forever. And all you have is a memory. You have a memory of a meal that made you feel good in that moment, and the cash has evaporated. That's what you invested in that moment. So what we are hoping that you will do is the discretionary resources that you have, I say your entertainment, feel good, self-care money, divide that in half, what you would normally spend during the course of a month. And then as you learn more and more about investing, take what you would have spent on that meal, go ahead and buy a piece of a company or an investment. The money's still there. You own a piece of the company. It has the ability to grow in value. And think about it this way. Your mindset already was willing to go and spend money on that meal where your cash was going to evaporate and you wouldn't see it again. But now you are taking part of that. This is discipline. And now you are investing it. And that's now building wealth. So I just want us to really think about how we see our money, because if we don't see our money that way, we will be afraid to move forward in investing. So Robert, I'm going to throw it to you about what should we look for in companies? We have the Cash App piece, we have the Robinhood, we have Stash, and a number of other apps. We don't have to get too technical. And also we have financial advisors out there. All right. So what should a person who's a novice begin to look for in a company to invest some of their resources in?
Okay, thank you, Vince. So normally you want to look at the actual price. That's always the first thing. If it's $5 or less, then it's a company that you probably want to stay away from starting out. Once you put dollars in, if you put $100 at $5 a share, it comes up to about like 20 stocks. You just purchase about 20 shares of stocks. However, that's $100. If you see that go down to $4 or $3, that $100 quickly goes from $100 to $80 to $60. And so when you have those stocks that are $5 or less, they are high risk. They go up and down. And usually the lower the stock, we call those stocks $5 or less, penny stocks. You want to look at the price first. Moving on from that, you want to say, well, is this something that I actually recognize? What do they do? You want to find out first before investing in something. I mean, you just wouldn't give your money to anybody off the street. So if you're looking for a certain company to invest in, you want to actually find out from, your research, what are the main drivers of revenue for this company? And from that, higher capitalization, meaning that is this company worth 300 million? Is it worth like Apple, like 1 point something trillion? As an investor, when I put that money into there, you are looking at those types of things, saying that, man, this is something that I want to take a part of, or be a part, take a part in as far as ownership. But at the same time, I want to make sure that I'm getting a dividend or I'm getting some growth from that company. That's the short end of it. It's very, more detailed if you have the time. But this is why some people, they look at this and say, you know what, maybe I should just get a strategy first and then go from there. So that's my take on what to actually look for, the price. Also, what does this company, what does it do? And also, what can you get from this company as far as past trends? Is it moving up or is it actually losing money?
So it's pretty good to begin to look at a 1 year or 3 year or 5 year, how that company has performed in terms of its stock price and so forth, right? When you begin to do your research, because a lot of folks, they start hearing a lot about a company. And I'll use this as an example. We won't go into all the technical aspects of the GameStop, but if you don't know anything about investing, and all of a sudden you started hearing about GameStop and how GameStop is rising, many folks immediately want to go and buy some GameStop. But what you're doing is you're actually buying it at its highest level. Obviously, I wouldn't have bought GameStop, but I'm using that as an example. Just when everybody's talking about a stock, that's probably the time you need to sit back and just wait for it to rise. And I'll use this analogy, ladies, when things first come out in terms of nice shoes or designer stuff or whatever it is that you go shopping for, do you get it right away or do you wait for that price point, that 20, that 30% off? Do you buy it at full retail price or do you wait until there's a sale? That's the approach that we need to take with our purchasing of stocks. Just because everybody's talking about, that fine purse that you like, don't mean you need to go get it right then and there. It's cool to just wait and see what that price is going to do. If it goes down and you still want it, then you can get it so that when it goes back up, you can make some money. Robert, you can correct me if I'm wrong, but I think many folks have taken a wrong approach to selecting companies because of what everybody's talking about. What do you say about that?
I would wholeheartedly agree. And we have a term, we call that, market risk or, news risk. There are many different types of risks that we kind of measure. And like you're saying, Vince, when they see that stuff plastered in the news in these groups and stuff like that, people, they usually let their guard down and say, you know what, I'm going to buy it just because I heard it in a group or I saw it on the news. I want to be a part of this thing, and not really doing the research. They just blindly buy these things, only to find out that because of the price is perception of what people at the time think a stock should be. If a lot of people is buying it at that time, it runs the stock up. But after the fundamentals, after people actually do the research, they find out, say, hey man, I think I overpaid for this. They start selling, and you have bought in at the high. They start selling, it takes the price down, and now you're stuck with something that you probably paid $150 for. That's probably no more worth than probably $40. So you want to be very cautious of what we call pump and dumps. I don't really want to say pump and dumps because these are legitimate companies that are traded on the exchange, but at the same time, the price of that stock is driven in some part by market news. You want to be careful of that.
So basically, that's why we do our homework. In other words, if someone is talking about a stock, what you would probably want to do is don't get so excited about, I need to get in, I need to get in quick. What you need to do is, if that does pique your curiosity, what you should do is now go back, you can Google the company, do some research. And he talked about looking at the historical performance of a particular company. And if you just want to see where the value of that stock has been during the course of its inception or over the last 3 to 5 years, you can kind of see where it might go up and down. If that stock is at its all-time high and everybody's talking about it, that is not a point you want to go and invest in, because guess what? It's at an all-time high. You want to wait till it gets back to that mid-range of what it was 5 years ago or 3 years ago, and in between that peak point and that low point, and ultimately do additional research around the company. Know something about the company. What does a company sell? What are its services? What is its market potential for expansion, development, and growth? What is its ability to attain its customer base? Is the product one of those products that is I would call it just something people have to have? And, when you start kind of getting an understanding, the Word of God says, above all things, get wisdom, and in all thy getting, get an understanding. So before we jump into something, we got to pray to God. This is what we call seeking him first and the kingdom. Then he'll give us wisdom around what we see, so that we don't anxiously jump into something that we're going to regret. That's how we apply the scripture to the real world stuff that we're dealing with, is don't be anxious about anything, and in all things pray. So when we look at these companies, know something about the company. I said the other day that it's so important, look around in your house. What are you buying? What do you believe in? What products, dishwashers, refrigerators, appliances that you buy when those things break down? Why do you buy them? It's called behavior consumerism. What is it that people tend to buy when they don't have it anymore? And if they are consistently going to that particular company, that particular brand to buy it, then you have a company that's probably worth looking into, because it does have the ability to retain the customer base, but it also has the ability to expand its customer base. And so when that company has the ability to expand, create new products, that creates an opportunity for it to create additional revenue, which then drives up its profit margins and so forth. Robert, you can always correct me if I'm somewhere off, and please do it if I'm wrong, because again, I'm not an expert.
No, you are definitely on point there. And that's where you have to spend time. You really just can't go by what someone else is doing. And I want to use the same example that you used with GameStop. I mean, right now it's trading at about $40 a share, but some people bought at $3.50. And to go from $3.50 to $40 a share, it shows you inconsistencies that can be played into the market. We like to brag in America that, man, we have a very standardized system, and for the most part, that is so. But there are major inefficiencies when it comes to driving up prices and how those prices actually go up. So you have to do the research. Without the research, if you don't have time to do the research, that's where I say 9 times out of 10, get a professional to say, let's build a plan, strategically go by that plan, so that you would decrease your chances of being hurt financially as you're investing your money.
Wonderful. So let's go on to the next question. Then I'll open it up after we get through with our primary discussion for some questions. But how much should a person invest? We talked about investing. Once you've done your homework, once you have, you weren't anxious, you heard about these companies, you see Vince McCaskill posting his daily Cash App investments. And let me just preface this by saying that the reason that I started this group and the reason that I share that is to encourage you not to be afraid. I'm not saying that you need to invest in everything that I'm investing in. I have my own particular strategy. But I've always said, even as a pastor, as a faith leader, that I can't take anyone anywhere I have not been. I would be a fool to be trying to tell you to invest, and I haven't even begun to invest 1 cent of my own money. So with that being said, when God pulled you guys into this group, I just put this group out there and he pulled you in. I knew that it was going to be important for you to receive the same kind of information that he gave me around how to move wisely in this. And so that's why I share what I share, to keep people motivated. And even I show my losses on any given day. So Robert, how much should a person invest? I mean, I'm just starting out. I know I can. I see Cash App has an opportunity for me, and again, Robert's not going to endorse any sort of thing that he can't do that. But let's just say I have access to be able to purchase stock through different platforms, and I don't have to pay brokerage fees at this moment. How much should I invest if I'm just now starting out? If I have $1,000 to invest, how much of that should I invest?
Well, I like the first analogy that you gave earlier. You know, you have to look at investing in a sense, if you have a real strategy, as an expense. So think about if you're paying cable and internet, $200 a month. Do you expect to call Comcast back and say, you know what, I would like to get my $200 back for the money that I spent on the service for, month of February? The answer will probably be no. Wherever you invest, that should be treated as an expense that you're not trying to get back. Okay? If you spend money on a cell phone bill and it's $50 a month, you have to treat investing as an expense. That's $50 you're not going to get back per month from a cell phone bill. So that amount should be clear. Whatever you put in there, $50, $100, $200 a month. That should be treated as an expense, money that you're not getting back.
Well, what do you mean, Robert? I mean, I can hear someone saying, wait a minute, it's not an expense. It's my money. Why should I? No, I don't know if I want to release this $50 to stock because I'm afraid to lose. I don't want to lose anything. So what do you mean it's an expense? I don't understand.
Awesome. Good question, because we're looking at time here now. So the biggest thing that you have on your side is 3, 5, 7 years. Okay. So you get to think of this thing past 3, 5, or 7 years. If you think of it as right now, that's an expense. You're not going to get that back. So over time, you could lose the money, right, in a short period. But it has shown historically that 5, 7 years out, you're going to have a positive return. And that's what we're trying to really get people focused on, is the long term. It's very exciting to be able to put, $10 into a stock and man, you get $15 back the next day. Okay. It usually does not happen. But if you have a strategy in place where you're putting money in as an expense, 5 years down the road, you're going to see, wow, this is what the magic of compounding returns and interest, this is what it would do for you. And that's what we're trying to get them focused on, is on the long term and not the short.
So it's really about a renewing of the mind. It's a shifting of how we see money, how we spend our money. It's a behavior shift. So when I think about what you're saying is it should be treated as an expense, that goes into you should always pay yourself first. Anything that you make, you should pay yourself first. Listen, I know you have bills. We all have bills we have to pay. We have to heat, air, electric, water, place to live, car, all that stuff, clothes we got to buy to go to work. But if you never pay yourself first, whatever that percentage is of your net income, you will always find a reason not to pay yourself, because there will always be something that pops up. But if you say to yourself, you know what, I make $1,000 a week. I'm going to take 10% of that and I'm going to invest it. That's an expense that I have. That's a bill I got to pay. So I'll automatically take that out to pay myself. And guess what? You don't see it anymore. It's there. But in your mind, it's an expense it's a bill you had to pay. You had to pay yourself first. And that thing will then grow. But our minds have to shift. Some people say, well, you know what? Listen, when I go to the restaurant, when I go buy those nice pair of shoes, or when I go buy that nice car, at least I have that car. I could hold it. I could feel it. If I go out to that nice restaurant, I have the good taste of that meal. But let me ask you this, with the meal, when it's all said and done and you paid your tip and you paid for that food, all you have now is a memory. 5 to 7 years, you won't be able to grow that money because that money's gone. All you have is the memory of that meal. So now what you want to do, you have to really get away from short-term gratification and really look to long term, because this is really about generational wealth building. If you, I'm 50, so let's just say my outlook is 10 years. I want to see my investments really start to do some things over the course of the next 10 years. But if God brings me home before I hit 60, yeah, I may not get to use it, but my daughter or my wife will. It's leaving an inheritance. If I do live to see that age, then guess what? It's a good thing, because now I can use it to do some other stuff. But you're building wealth. That's something we have not been taught, because in this society, being awake in this society is literally being in a constant rage. The great author, I can't think of his name right now, said that, but there's so much trauma that's been inflicted on us. We've had to fight and claw. I remember I guess it was The Color Purple or somewhere, all my life I had to fight. We've had to fight. We've had to play defense while trying to play offense. Certain people didn't have to play defense. All they would do is play offense. They didn't have the institutional barriers that prevented them from being able to play offense. So they've been able to build generational wealth over many generations. So now, we're at a place now where we're dealing with the trauma of our past and our ancestors. But God is awakening us to certain things that will leave that inheritance, build on what we have, and be cheerful givers, and being willing to sacrifice the now for the later. Robert, it took me a while to really understand that. It did. And I can say that what I've learned is to have a long-term strategy, and everybody has a different strategy. I see a couple of people on here, Miss Green, who is a little older than me. She may not be able to do a high risk sort of investment portfolio because she wants to maybe benefit from that portfolio the next 5 to 7 years. So for someone who is, let's say, in close to their retirement years or in their retirement, but have a little money to invest, would it be wise for them to go after high risk investments, or what would be a recommendation to someone who has some money but cannot tolerate a lot of risk?
Yeah, and this is where a professional will come in to ascertain your risk tolerance. So there are a series of questions that we normally put people through to give us an indication of, hey, what is that threshold that will make you decide, man, I had enough? And so if we say, if you had $10,000, if you saw that $10,000 that you just put in March 1st, or say February 1st, if it was $8,000 February 15th, would you say to yourself, I had enough, I'll pull out, I'll take my chances with, a savings account? That's what we're looking for. And so usually in a short term, that would be something that we ascertain at risk, and that risk is mostly conservative. It's not, all cash, but it will be more fixed income, which are like bonds, things that you lend and you get coupons back or dividends from, and it will be less stock. So that allocation will fluctuate, depends on that would depend on your risk tolerance. If you have less than 5 years before you're thinking about taking down or making some type of withdrawals from those savings.
Let me ask you this real quick, because you've thrown out the word dividends. And for someone who's a first timer, that's so technical, they don't really understand that. So let's talk about a company. Let's just say I'm going to throw out Prudential. That's what I invest in. I'm not telling you all to invest in Prudential, but I'm going to use what I have. Prudential gives out a quarterly dividend to its shareholders, owners in the company. The last dividend payout was $1.12 per share. So the number of shares that you own in a company, multiply that number times $1.12, and that's what they pay out every 3 months. I believe that's quarterly to its shareholders. Robert, talk a little bit about a company that is a dividend yielding company, and that type of company versus, let's say, a Netflix that hasn't paid out any dividends. But I do remember when I got in Netflix 3 years ago at $1.60 a share. I wish it was $1.60 a share. $50 a share. And now I believe, I hadn't seen it recently, but it was like at $500 a share. But it hasn't paid out any dividends. It's just a growth company. Talk about the difference between those two.
So I like to put dividends not in dollar amounts, but in yield or percentage. And so basically, I'm going to use the same example that you use Prudential. That dollar amount that you gave that they're paying out per share equates to about 5.5% in yield. Can you get that with a CD now? Probably not, right? However, that dividend is based off of the fluctuation of the price. Usually, if it in a short period of time, if the stock price of Prudential goes up drastically, the dividend would probably decrease a little bit. Instead of 5.5%, they may decrease that dividend down to compensate a little bit for the growth of the stock for that period. But Prudential is a financial company. It's pretty stable. With 5.5% dividend, that's a good reason to own that stock. Okay, a very good reason, and it's a very mature company. Trace that against something like Netflix or Apple.
Right.
Apple does have a dividend, within the last couple of years.
27 cents per share. Yeah.
That's very good, right? However, you usually own Apple and Netflix or Google, Alphabet, if you will, because of the potential growth. Two reasons to own a stock. You either own it for the income, the dividends, the yield that it pays, or you own it for the growth in future dollars. Okay, and the price of that stock is always the perception of what people think it is in future dollars. Right now, let's just say Prudential is trading at about $80 a share, not quite sure. It may not grow, but 5.5% dividend yield percentage is enough reason to own that stock, even if it does not grow. So you have growth stocks, or you have what we would like to call value stocks. Value stock is not really limited to if it's paying a dividend or not. It means that according to everything that the company owns, all the assets minus the liabilities, we have a price on this stock. And we think that because our intrinsic value is higher than what the book value is, let's say the book value is $80, but we think it's worth $100, then that's a value stock. It's trading at $80. We want to buy it at $80 for the potential because we think it's worth $100. So growth, which people get excited about the growth, they usually don't pay a lot of dividend or not much or none at all, versus value, where you got in on the stock and the dividend usually that it's paying. That's what you want to look at when it comes to owning a stock.
Okay, so I love what you just said about the yield percentage of a company that's at 5% or 5.5% in terms of what it pays out, and you think about what your average savings account typically pays out, which is not what is the average savings account pay out in terms of interest?
2-year CD may get you 0.4%.
0.4, not even a full percent. Okay. Right. All right. Now, so when you think about your savings habits, if you're a saver, first of all, that's absolutely wonderful because you got to start somewhere. You got to have a savings or something, right? But at some point, if the money's just sitting there and it's been sitting there for a long time, it's nice to look at that in terms of I have access to that if I need it. But what if you had the ability to allow that to grow at a certain level and the compounding interest and the dividends? Because what I typically do, this is what I do, and Robert will correct me. I've given him permission to correct me publicly, okay? I'm not beyond being corrected. What I typically do is when I get a dividend payout, which is a quarterly payout from that company, I don't take that money and go spend it on something fun. I literally reinvest it. I buy more of the company, or you can take that dividend and buy another piece of a company. However you choose to do it, I reinvest it, okay? And it will continue to grow. And so that's what you got to look at. I mean, more than anything, if you have a long-term strategy for saving, then maybe you want to look at other options that will allow your money to grow at, let's say, 5%. And let me throw this out to you, Robert. people talk a lot about losing and winning in the stock market. So like today, I was looking at my portfolio at one point, not the portfolio you have of mine, but another one. And I said, man, the stock market was taking a hit at that time. It was down 300 points and everything that I had was like down 2%, right? Now, a person who doesn't understand this will immediately get a little anxious and scared, like, oh my God, I got to sell, I got to sell. Listen, you don't lose until you sell it. This is something called unrealized gains or losses. In other words, that stock has the ability to go back up the next day. And trust me, I watched this for a long time, and so has Robert. You have a day when stocks might go down 5-6%. You don't want to see that happen, but it does. But again, you're in it for the long haul. You're not in it for what we call short sale. Like I'm getting in it today. If I buy something at $7 and tomorrow it's at $9, I'm selling. There's some tax implications around that, which that'll be another discussion one day. But some days it will go down, the next day it'll go up. You don't realize the loss or gain until you sell it. Robert, can you expand more on that?
That's where most of the retail investors, mom and pop, the individuals, that's how they really get hurt, because they look at the short term, turns, the ups and downs of the market. And we like to call it behavioral finance. It's emotionally difficult to see your account go down, down, down. It's just hard to watch and say, oh my goodness, I could have put that in the savings account. So this is what you get with ownership. When you deal with stocks, you're owning. What is it called when you leave your money in a savings account or a checking account? You are lending. People don't see it as lending because they take those deposits and they reproduce that in a mortgage. They lend it to other people. You're lending it in a checking or savings account to a bank, but you're getting very little for it. They're lending that same money in a checking or savings account to other people for business ventures, for mortgages on a home, for auto finance and different things. And so if I can say one thing about, just leaving the mindset of lending, a checking and savings account is lending to that financial institution. When you get stocks, you are owning, and you get to reap higher benefits if you're able to weather those short-term periods in the long term. That's the major message right there, Vince.
I just think you opened the door, because folks are looking and thinking, wait a minute, when I put my money in a checking account or savings account, I still see those numbers there. I haven't lent anybody anything. Can you just briefly, so we can go into something else, talk about the banking industry related to how they value your savings and checking accounts and what they do with the cash, because it's really about the bank having access to the cash to be able to lend and so forth. You still have that money, but they're leveraging your money to make loans, and they're making money off of your money. That's why they pay interest. Am I correct, Robert?
That is correct. So think of this in simple terms. This bank has $1 million worth of deposits. You and other people say, you know what, I trust this bank to give me my money back when I need it. It's liquid. I can get it by the minute, by the day. And so they take that $1 million, and the federal government tells them, well, because you have $1 million worth of deposits, that qualifies you to lend out to make $10 million worth of loans, whether that be auto finance, mortgages, or whatever. So they're leveraging your deposits by a factor of 10, because this system guarantees that they can only do so much. They can't go as risky as we can, but as a financial FDIC insured institution in these United States, they're able to leverage that by a factor of 10. So they may lend, you could go right now, they'll lend out a mortgage now 3% somewhere around there, 3-4%. But what are they giving you? They're giving you 0.4%, right? So they're making like 100 times the amount of the money that they're giving you, as opposed to what they are lending out to other corporations and individuals. That makes sense.
Right. That makes all sense in the world. And then for some accounts, they're charging you a monthly fee to have your
that's how they make their money. That's how they make their money.
That's how they're making their money. And so I want to break it down for even the person who might just have $500 in their savings or checking account. So basically what Mr. Peters just said is if you have $500 in your savings account, that bank now has the ability to go to the, get 10 times that. They leverage your $500 to say, because they trust that you have it there. Now they can go get 10 times that $500 to loan to other people, make money off that loan because they get it at a very low interest rate. They charge people a higher interest rate. They make the interest is what they make. They have to pay that principal back. They've used your money as collateral to say, we have these deposits. And then for you putting your money there, we're only going to give you 0.4%. That's the system we're in, folks. That's the system we're in. They never want anyone to know this stuff, right? So since I'll just say this, I've been blessed. The Lord has blessed me over the years where I was able to elevate, become a real president and CEO, not a mom and pop, created a little small business. I'm the CEO, but a real CEO of a major organization that deals with millions of dollars. And the moment I entered that sort of realm, other CEOs from major companies began to enlighten me around certain things. Okay. Now, what they don't know is when they're telling me this stuff, I'm telling everybody I know, right? Because it was freely given. So these are the sort of things that have been hidden from us, right? And so now you have to ask yourself, wow, they're taking the money that I have. They're able to go borrow 10 times that based off of what I put in. They loan that money they borrowed to someone else. They make money off of that, but I only get 0.4%. Let me go own a piece of a company. Let me go put that money into something that's going to pay me a higher return for my hard-earned money.
Awesome. That's it in a nutshell.
Okay.
A lot of people have blamed financial banks for cheating the lower income people from true returns that they should have normally qualified for in the past. And so if your money is with a savings account, and you need a checking account, trust me.
You do. We all do.
You need that. However, if you have $40,000 in a checking account, in a savings account, or $10,000 in a savings account, and you're not touching it, you're not keeping up with inflation. That means that $10,000 is worth less in the future. And you have to get smart with the system and say, you know what is my real return worth on the dollars that I'm not even using, because it's sitting there. That $10,000 at that bank is been leveraged by a factor of 10 of $100,000 lending out to other people, and they're making their money off of the leverage with the loans.
That's right. Oh my goodness. We're almost done with our part, and then we'll open it up to questions. I don't want to keep everybody too long. We're 53 minutes in. Robert, I want to ask you this again. What's an investment strategy? What's an investment strategy for each person?
Right quick, this right here is a map. Some people just like to run. If you're exercising, you run, you're doing sit-ups, you're doing push-ups. An investment strategy is an actual plan. It's a regimen. They're saying, I have a goal, and this is the routes that I'm going to take to obtain those goals. So an investment strategy or plan will consider your risk tolerance plus your financial abilities to obtain a certain financial goal. That's it in a synopsis. You just don't want to run for the sake of running. You want to make sure that you are actually doing things that's going to benefit you greatly or efficiently towards a specific goal that you're doing in the financial arena.
Wonderful. So I'm going to just read through some questions here that was posted on Facebook to our group when I said we were going to have this particular session. I think you've already answered Jay Henderson's question about what should I look for when deciding if a stock is a good investment. You've already done that. And then Verna McKinney asked a question, what are options and how do you buy them versus buying stocks? What are options and how do you buy them versus buying stocks? You haven't answered that one. What are options, Robert?
Okay, so when you get into the realm of options, you're saying I want to take control of a certain stock without actually owning it. So you can do call options or buy options. I'm not trying to get into detail, but
Right.
you're leveraging more shares with less money for the sake of growth or for the sake of receiving dividends from that option. And when you don't own the underlying stock, that's what we call a naked option, and you can lose your head off if you just go out and buy options, these option calls or puts, without actually owning the stock. So it's leveraging by a bigger factor to control larger shares of a underlying position without actually owning the stock.
Wonderful. That's that in a nutshell. And Verna, thank you for your question. And of course, if you have further questions, Robert is also in this group as well. Mia Okamoto asked a question, please share your top economic political indicators that can sway the market. How should you factor these into your buying decision?
Okay, this is so political. I'm gonna give an example first. So let's just say that President, I keep want to say Biden, but it's President Biden, right? Mm-hmm. He comes out and says that companies are going to that makes over $10 billion will be taxed fully at a certain rate without the benefit of any deductions. That right there would take the market into a swing. It'll affect treasuries, and it will also affect the prices of those stocks that it actually affect, because now there's no way to get around those paying those taxes because they're not allowed deductions. So that's going to take the price down. We look at those as political risks because so much can happen, but that's why politicians are usually slow by making direct statements that's going to affect larger companies when it comes to tax implications. So that's one way of looking at it. What if the question is what I personally look at when I advise other clients? My thing is to not be concentrated in any one area. So we look at the sectors. What sector does that affect? Whether it's financial, the health sector, the info tech sector, the consumer discretion sector, consumer staples. These are things that we actually look at to make sure that if something does happen, that all of our eggs are not in one basket, so that it will have a drastic effect on your portfolio. So I'm trying to give you something in general that we consider so that your portfolio does not suffer basically within a short period, but sometimes those things can drastically go out, multiple months and even up to years.
One final question from me, and then we'll open it up to the group that's in here. She asked, how do you feel about cryptocurrencies?
Okay. So for one, they're coming into its own, meaning that these crypto currencies were not really accepted by the financial markets. They are slowly growing on the financial markets, and the more institutional money is placed in it, it becomes more liquid and it becomes more stable. So I put it in the same category as you would see gold, all right? But gold at least is an underlying asset. Cryptocurrencies, they have no intrinsic value, meaning they do not own anything, they do not sell anything, they do not provide any service. They just give you the benefit of, say, if you want to make a trade, you can use this money. And we're going to say right now that Bitcoin is worth $50,000 a share. Oh my goodness. Why is it worth that? I have no clue. But you have to treat it as gold that has no fundamentals whatsoever, and depend on other institutional money to keep it afloat and that high, which is going to be very hard to do. So take that as you will.
All right, so we heard that. So we're going to take just a few minutes to answer any questions. We see Mia Levon is on this particular Zoom. We see Sharon, Kenyana, we see Jan, Katrina, Janice, Miss Green, Gavette, and Lindsay Porter. Jan, I know who you are. I know you changed your name. So you can, okay, so Mr. Peters, can you share Oh, okay. So she wants you to share your contact information, when you have an opportunity. So Jan, what I'll do is I will text you and Mr. Peters in the group text and introduce you because I know who you are.
I can also put my email out there if you don't mind.
Put it out there as well, so that they can do it. I see some chat. Okay, okay, good, because I'm not watching chat right now. All right. Okay. Is there any? Okay, so Levon says thank you. Okay, cool. Is there anybody else? While you have Mr. Peters for a few minutes, he has to go back and look at the stock market. He has to make sure my portfolio is doing what it's supposed to do. Now let me tell you what I do with him. I have the foundation that I run, which is called School Seed Foundation, has had the privilege of having a few, a 7-figure portfolio, and my board entrusted those funds to Mr. Peters. Then after my daughter is getting ready to graduate from college, I got through paying off her college, so she's coming out debt free. We don't owe anything. I've now turned back to investing. I did have a 529 plan, and we'll be talking about that plan like that later on during the course of this group. But is there someone right now who would like to ask Mr. Peters a question? Unmute your mic and ask your question now.
Hi, Vince, it's Yvette. I just actually put this in the chat. We hear, or at least I'm hearing so much chatter these days about Forex or the foreign exchange market, and that all of this is kind of new information to me, but I'd love to get your insight and take on that.
Okay, so when you're dealing with foreign exchange markets, you have to be very savvy. You have to, know the trends, and it's a trend. It's not really for investing for the long term, because those trends can change at the drop of a dime. You may have someone like, for instance, Great Britain decided to drop out of the EU. Oh my goodness, that's a political risk that you're looking at now. Now you got to look at what the foreign exchange for the EU when it comes to those dollars compared to the British pound. What would that look like? And so that would send things into a frenzy. I am very skeptical. You need to put that into asset category like alternative investments, which should be no more than about 5 to 7% of your total investable assets. It's okay to play with it, but as a way of building wealth, that's something that I probably would not use, in any high degree of allocation to build wealth. That makes sense.
That's good. Katrina, and Katrina Booth, Katrina Pittman, one of our classmates from back in the day, Marion County, West Marion High School. She married a really good friend of mine years ago, Mari, God bless his soul. She has a question about a book recommendation. Do you have any book recommendation that will provide good understanding of this process?
Oh gosh, I'm gonna be honest. Every book has its own take from a personal perspective when it comes to the actual stock market. My personal belief is to get a part of a learning series where you can find out the different aspects of the market without reading a book. A book is good, and I love it, but you want to deal mostly with workshops. And I'm going to paste inside of this group where I have a personal workshop on my website that is free. And also another one is in real detail by Morningstar, and it's free also. If you want to find out some real deep information about the stock market, ETFs, mutual funds, stocks, evaluations, all that stuff, I'm going to put that also in the link if you don't mind, Vince.
That's absolutely okay. They've asked for it. One of the things that Robert and I talked about, because I talked to him about creating this group, and I said, I don't want people to come in and think that, we're trying to sell them something. That's not. Only thing we're trying to do is help you get an understanding. And again, I'm going to bring in people I trust. Most importantly, the reason that I brought Bobby in, not only did we go to high school together, but he's also well trained in this industry. But he's a man of God first. I wouldn't have brought anybody else in here and quite frankly, there are a lot of financial advisors who wouldn't even talk to folks if you didn't have $10,000 to start out with investing. He took my pennies, literally, and he's able to invest. And I have so much coming out every week, not only for me personally, but again, for the foundation I run, and also for the ministry, BGI, through Inspire Foundation. We made a decision to invest in the market. That's how you build your assets. So we have a certain amount coming out every week. We don't ever see it. So it's like an expense. That's how you build wealth, because you'll always have bills. I'm not proclaiming that over people's lives, but as long as you have to heat your home, that's a bill, unless you own the company that heats and you don't have to pay anything. So we're going to always have expenses. And here's another thing that I want us to really understand about the Word of God, because all of this is ministry. The renewing of the mind allows you to see that perhaps our thinking around how we use our money has caused us to not appreciate what we have. God says he'll give us what we need above and beyond. But what if our desires are above what we receive? That's why you have people upside down in certain things, because they have a desire to go buy this stuff, but don't have the funds. And then they say, I don't have what I need. I can't invest. But if we really flipped our thinking and we had an attitude of gratitude for what God has given us through whatever it is we do, working and so forth. God, I'm thankful and I'm grateful for what you've been able to give me at this moment. So when you have an attitude of gratitude, now you can appreciate whatever comes your way. And then what God will do is he'll reshape your mind around how you spend your money. The things you thought you needed. One thing COVID has taught us in many different ways, pray for those who've been infected and sick and lost their jobs. We know that. But for many of us who stayed locked up in the houses, guess what? We were cooking at home. We weren't really going out to the restaurants like we used to. There should have been an increase in your life if your expenses around fast food and going out decreased and you cook more. You see what I'm saying? That's so important. Someone has a question. Let me see. Sharon, let me go down just 1 second. Miss Page, Sharon Page has a question about 401k. She says, it looks like I should be investing in
The market
versus
her 401k.
Versus 401k. You want to elaborate on that, Robert?
401k is free money. So let's just say if you make $100,000 and your company says up to 6%, whatever you put into this 401k, we will match 6% of your salary. So that's free money. So if you put in 6% of 100,000 is $6,000. They're saying for no other reason, because you put $6,000 here, we're going to put an additional 6 in it.
That money.
Yeah, you definitely want to max that percentage out first. But yes, participate in that, especially if your company is matching. Yes, ma'am.
If your company is not matching and they just have a 401k.
Do it anyway, because that's really money that's coming out your check you don't see. That's the first way where we're talking about an expense. Do it anyway, because at least you should be able to invest in something that's going to outpace inflation. And plus, you get what they call a tax benefit. So if you put $6,000 in there, that $6,000 they take away from your salary that you get to claim back on your taxes.
That's correct. Oh, this has been good. I think we're good. This is NPRN Radio and also within our BGI Investment Group. This has been such a wonderful time. We're about coming to a close right now. Mr. Peters, I thank you so much for taking the time. Most people charge for this type of stuff, people. I just want you all to know this. We're going to have so many other discussions, and I'll bring in others and so forth. But the Word of God says to us that He has freely given to us. What you see in this world is people get a little understanding around something, and then they want to package it and sell it. All right. I'm a giver. I'm like, God, you gave me this wisdom. You connected me to the right people. You've given me a little influence. I'm not going to turn around and pimp that. I want to freely give to others what you have given to me. And here's what I want each of you to do. If you have a cheerful heart, a giving heart, 2 Corinthians 9, verses 6 and 7, the Apostle Paul begins to talk about giving, and a lot of times people just use the giving around what you give in the church, right? But this is really related to every aspect of our lives. It says that he who sows sparingly shall also reap sparingly, but he who sows bountifully shall also reap bountifully. It goes on to say, don't give out of pressure or necessity, but give because God has given you the unction and you do it cheerfully. For God loves a cheerful giver. So as we get ready to leave here, I want you to just be reminded that this information is freely given to you. And we're going to be here. We're going to learn together. We're going to be transparent about our mistakes. We're going to do so many different things. What I want each of you to do is find some people in your circle of influence and invite them into this group. Let them know this is not a selling anything, or if they just want to grow in understanding, then now you freely give to them what we have given to you. And we'll begin to answer more and more questions. We'll talk about college 529 investment plans. That's something that my wife and I did many years ago for my daughter. And that's part of the reason, it was from God, that we were able to get her through Spelman, and we're debt free. She's come out of college with no student loans, and we don't owe anything. That's because God gave us the wisdom to put back, invest, sacrifice. And so what I want for you, and the thing that we did for at BGI, we have members there. We set up what it's called the BGI 529 Faith Forward College Savings Plan. The same company we use out of Utah, we set this thing up where we have the ability to create different accounts for members' children. And what we have decided to do as a ministry, because my ministry is about setting the captives free in many different ways, we decided that they'll sign up for this through us, and whatever they give to BGI to support the ministry, we made a decision that 10% of everything that a person gives, we will put 10% of that into a 529 college investment savings plan that the parent can see. The beneficiary is the child, and they can watch it grow. So here's the thing. If you only give a dollar, we put 10 cents in, right? So the more you give, the more you shall receive. And that's a biblical principle that we're trying to teach people, that God does honor what he says. So be a cheerful giver. Bring some other people in, and we hope that for this particular 101 session, that this has blessed you. All minds clear? No other questions? All minds clear. This is the Memphis Preachers Radio Network, MPRN. I am Vince McCaskill. Thank you for joining us. God bless you guys on the group, and we'll talk to you later. Have a great day.
Bye-bye.
Bye-bye.